Happy Monday, everybody. I hope everybody's doing well. I hope everyone had a great weekend. It seems that winter's trying to make its way into Chicago. I hope weather by you is doing okay. So today is Monday, November 15th, and this is your Monday market update video. Let's recap what happened last week. Let's talk a little bit about what we're going to see this week. Monday last week saw slight gains as we continue to digest the October jobs report from the week prior. Remember, as I mentioned to you last week, the Fed started to roll out their speakers again. So Monday was full of Fed speak, checking out what the market's going to think about possible rate hikes, multiple rate hikes in 2022. This is not what the market has priced in right now, but it's possible we're going to have to start looking at this. Everyone seems to agree that the global economy continues to recover well, but at this point, the market is pricing in a slow taper from the Federal Reserve, $15 billion a month. That'll take us into June of next year, and no interest rate hikes at least until then. You're going to be getting close to the midterm elections by then. Excuse me. So they may hold off a little bit more. We'll see how some of the inflationary pressures start to clear up. If they do, supply chain, labor markets, we could see interest rates hold off and inflation stay under control. And yes, that's a lot of ifs. So the S&P 500 drifted around for the day and closed in the middle of the range for the day, up slightly on the day, making it a positive 8 days in a row. So Tuesday came in, opened higher again, but soon turned negative and stayed that way into the close. S&P 500 was down about 1/3 of 1%. Tesla was a big pressure on it as it moved down on news that Elon Musk was selling some of his stock. Now, no matter that he has so many shares that he has and that he had to sell it because he had some options expiring and he had a big tax bill, but that wasn't important. Remember, when stocks like this have any kind of news, people use it as an excuse to sell, and so that's really what happened here. And remember, just math. When stocks like this that make up such a big part of the S&P 500 index, when they go down, the S&P 500 index goes down. So the 10-year yield also came down further, back into the low 140s. This is really a product of global yields. We'll talk about that in a little bit, but we'll keep an eye on this. We still think it moves its way back to 2% before the end of the year. Stocks sold off on Wednesday. Yes, you heard that right. Actually, it happens every now and then. It's less frequently more and more, but it does happen. The S&P 500 was down about 1% for the day. The markets reacted to the CPI data slightly, but more specifically, it reacted to a 10-year bond auction, a 30-year bond auction, but we'll talk about that just in a second. It was a hotter than expected inflation report from CPI. Jobs numbers were better than expected, and the 10-year Treasury did, in fact, have a big move. We'll talk about that in a second. The yield climbed 16 basis points before it closed up 11 basis points for the day. But really what it was a really bad 10-year Treasury auction. And what that really did was it brought those rates up. The reason is important, but the fact that the rates moved back up is more important, especially for the short term. The yields were the main driver of the market. Market actually was calm after the CPI number, but it wasn't until that 30-year Treasury auction that the market actually started to sell off. So remember, we actually had that kind of a sell-off a couple of weeks ago where we had a bad Treasury auction, and that actually brought a couple of days of selling. So we'll just have to see what that goes on. Higher rates, of course, hit technology stocks the most. NASDAQ was down 1.66%. The Dow was down 0.66%. The S&P 500 was up 0.82% for the day. Inflation report is noted, but the Fed keeps reminding us that the inflation is transitory. And as long as they stick to that playbook, we have to expect that rates are going to stay low for now. So Thursday was quieter. As I said, the bonds have been pushing all the buttons in this market, and the bond market was closed on Thursday for the Veterans Day holiday. So the S&P 500 closed the day near flat. It wasn't much news to discuss. They talked a little bit about why the markets weren't closed for the Veterans Day holiday. It's the same argument they have every other year, but we don't ever close for the Veterans Day holiday. They always pointed to the other holidays we close for the veterans. So right or wrong, the bond market was closed. Most banks were closed, no mail, and a pretty quiet stock market. We did get news from China that some of their regulations were being relaxed a little bit, so that did move the Chinese part of the market. Market gapped open on Friday. The market got its legs back after a sleepy Thursday. Bond market in the U.S. and globally stabilized, and that allowed for the big name growth companies to move up, lead the market back a little bit. S&P 500 closed up about 0.75% for the day, but it broke a 5-week winning streak, and actually for the week, the S&P 500 was down about 1/3 of 1%. So this coming week is going to be a big week for a few remaining companies that report earnings. These will make a difference because these are retail reports. So led by Walmart, Home Depot, Target, Lowe's, TJX, Macy's, and Kohl's, and add in some big tech names such as Applied Materials, Cisco, NVIDIA. Top it off with some Chinese names like Alibaba and JD.com. These earnings have the probability of shedding some light on some chip shortages, supply shortages, for holiday shelves, and maybe even some Chinese regulation information. Not a lot in the macroeconomic data, which is normal following these last couple of weeks of jobs data and CPI and PPI data. Jobless claims are the high-frequency data that we get on every week, and that will be watched. Otherwise, retail sales, that overall number for retail sales will be out on Tuesday, and that may set the tone for the week a little bit also. And no less than 8 Fed speakers this week. So we know what that means. We can expect the unexpected. Washington still wants to pass the next social infrastructure plan, as that's called, by Thanksgiving. We also may see some more commentary from the Scotland Conference on the climate, on the environment. This has proven to be a very, very interesting time for investing. We've had moves like this in the past that influence things with the climate accords and the likes of that, but they have fallen flat over time. So this time we'll see there's a lot of reaction to this news. So just look at anything with electronic vehicles right now in the energy space, to name a few. No one is paying any attention to the fact and how we're going to generate all the energy to power all these EVs, but that's a conversation for another day. There are really only a few things that stand in the way of the next big move higher for stocks, but they're big items. So inflation is way above what we've seen in a long time. The labor force still doesn't seem to want to come back to work. Close to 10 million jobs are unfilled. Last thing to think about as we dig into this week. I read a commentary on the fact that the move in prices over the last 10 years, according to Fed data, has been personal consumption prices were up just over 18% in the last 10 years. Now, even with the recent moves we've seen recently, that's that number. But that's below the Fed's average rate of 2% per year. Now, I don't agree with the conclusion of the writer that basically they said that since it's lower than average, we shouldn't worry about that. So I will tell you, I don't know about you, but just because milk and fuel have not kept up with this 2% rate over the last 10 years, it doesn't make the most recent substantial moves in these prices over the past 6 months anything easier to afford. Not like I was saving that money over the last decade of we weren't seeing that growth, so I was putting that money aside over the last decade so I'd be able to handle these prices. I don't believe that's a good conclusion. Will inflation get out of control? I don't know. We'll see about that, but it remains to be seen. And $5 gas is still expensive, and it will make a difference. So I continue to keep an eye on inflation for you. Valuations in the stock market are a big thing we need to keep an eye on, so keep coming back to the videos, and of course, call me if you have questions to discuss. The president should be signing the bipartisan infrastructure bill today, and we'll see action in Congress on the bigger bill as well. We'll talk about planning for year end a bit more on Friday, so watch for that too. Have a great week, and we'll see you later.